Hello investors, it's Zil from Equitymaster bringing you investing insights to make investing simple and easy to learn. To stay updated on investing trends and the latest developments on Indian markets, don't forget to subscribe to this channel and like this video. One thing is clear in the world of finance, that markets don't like uncertainty. And 2025 has served up plenty. Geopolitics, oil price swings, and uneven global demand have kept equity indices on edge. For investors trying to navigate this landscape, the temptation is to either do nothing or chase momentum. Or take the third option, look for stability in cash flows. That's where high dividend yield stocks come in. These are businesses with strong balance sheets, predictable earnings, and a long history of rewarding shareholders, not just with capital appreciation but actual cash. In volatile markets, that matters more than ever. We've screened a set of 5 companies that offer both dividend comfort and business resilience. A set of companies that not only have a history of paying dividends, but also the balance sheet strength and earnings predictability to sustain those payouts. All 5 enjoy a dividend yield above 3%, low or zero net debt, consistent cash flow generation, and visibility on future payouts. Before we move on, please note this video is for information purposes only. It is not a stock recommendation and should not be treated as such. There is no opinion or view on any stock covered herein. Now with that disclaimer out of our way, let's get started. First on our list is Hindustan Petroleum Corporation Limited. HPCL is India's third largest oil refining and marketing company with 18.5 million tons per annum of stand-alone refining capacity following the full commissioning of its expanded Vizag refinery. It also operates a 9 million tons per annum JV refinery in Bhatinda and holds a 17% stake in Mangalore Refinery and Petrochemicals Limited. The upcoming commissioning of the Vizag Residue Upgradation Unit in Q4 of fiscal year 25 and the Barmer Refinery launch in calendar year 25 are expected to materially boost gross refining margins. Another key trigger is the proposed demerger and potential listing of the lubricant business, which is being actively pursued with the government. HPCL is also expanding beyond oil. It recently commissioned a 5 million tons per annum LNG terminal at Chhara and continues to invest in EV charging, ethanol blending, CGD networks, and compressed biogas. Crude oil prices have softened due to OPEC Plus output hikes and global tariff dynamics. Combined with the 50 rupees per cylinder LPG price hike, these tailwinds are expected to improve HPCL's gross marketing margins. In the first 9 months of FY25, HPCL operated at 106% capacity and gained market share in both retail fuels and lubricants. It also reported a sharp earnings recovery with Q3 of fiscal year 25 profit after tax rising to 30 billion rupees from 5.3 billion rupees a year ago. This combination of stronger cash flows, lower debt, and operational tailwinds create more room for future dividends. Between FY20 and FY24, HPCL posted a 8.3% revenue compounded annual growth rate and 4.6% profit CAGR, with an average return on equity of 13% and return on capital employed of 11.2%. Next on our list is ITC. ITC enjoys over 75% market share by volume of the Indian cigarette market. While cigarettes remain the cash engine accounting for the lion's share of profits, the company has built meaningful verticals in FMCG, hotels, agri-products, paperboards, and packaging. Over the last 5 years, non-cigarette revenue has grown at a healthy pace, driven especially by its FMCG segment. The government has avoided sharp tax hikes on cigarettes for the last 3 years. This has provided much needed pricing and volume stability, with cigarette earnings before interest and taxes margins now exceeding 65%. The recent 35 billion rupees acquisition of Century Pulp and Paper strengthens ITC's backward integration and scale in the paper business, an area where demand from e-commerce, pharma and food packaging remains resilient. ITC's cigarette business continues to generate steady cash flows. Its FMCG and paperboard businesses are growing, and the recent acquisition of Century Pulp and Paper adds to its scale. The company has no debt. ITC has paid dividends every year for over a decade, with payouts increasing steadily since FY21. Between 2020 and 2024, the sales and net profit have reported a 5-year CAGR of 7.8% and 10.6% respectively. The company's 5-year average ROE and ROCE stand at 26.5% and 34.4% respectively. Third on our list is Coal India. Coal India is the world's largest coal producer and supplies over 75% of India's total coal, with 80% of that going to the power sector. In the first 9 months of fiscal year 25, it produced 543 million tons and is on track to cross 700 million tons by year-end. With over 90% of output coming from open cast mines and operations spread across 7 subsidiaries and 1 technical arm, Coal India remains the backbone of India's thermal power supply. Despite its near monopoly, it sells coal to power plants at steep discounts to global prices. Even though pricing was deregulated in 2000, rate hikes have largely tracked cost pressures rather than market demand. Better realizations come from e-auction, non-regulated and washed coal sales. While commercial mining has opened up competition, Coal India's dominance remains intact. The demand outlook is supportive. India's peak power demand is expected to hit 270 gigawatt this summer and 363 gigawatt by FY30, according to Central Electricity Authority. That makes Coal India's role more critical. After a recent correction, the stock now trades below its 10-year average valuation, offering a hefty 7.1% dividend yield. The company has already paid 20.5 rupees per share in dividends so far this year. Between FY20 and FY24, Coal India posted a 8.2% revenue CAGR and 16.4% profit CAGR, with an average ROE of 50% and ROCE of 63.4%. Looking ahead, Coal India is diversifying. It has signed MOUs to explore coal to SNG gasification and critical mineral extraction and commissioned a 50 megawatt solar plant, which is the largest it has built so far. Fourth on the list is Castrol India. Castrol India is a leading lubricants player. The company enjoys a strong position across automotive, industrial and emerging segments like EV and data center cooling. In 2024, it sold 234 million litres, with 40% of volumes from commercial vehicles and 45% from personal mobility. Castrol India's total dividend for 2024 is 13 rupees per share, which includes a 4.5 rupees special dividend to celebrate Castrol's 125th global anniversary. The company reiterated its strong cash generation and commitment to rewarding shareholders while also leaving room for strategic investments. The business has grown at a robust pace. Between 2021 to 2024, the company's revenue and net profit have reported a CAGR of 6.7% and 2.3% respectively. The 5-year average ROE and ROCE stand at 60.7% and 45.9% respectively. Looking ahead, Castrol is sharpening its rural and mid-market focus with its essential sub-brand aimed at making Castrol more accessible without diluting its premium positioning. It has launched new lubricants for SUVs, hybrids and trucks, and deepened OEM partnerships with players like Tata Motors and JCB. The company's distribution now spans 143,000 plus outlets, including 600 Castrol Auto Service Centers and 36,000 rural workshops. It continues to invest 8% of revenue in brand building and is relaunching its flagship active product to strengthen its presence in the two-wheeler segment. Last on our list is Power Grid. Power Grid is India's largest power transmission company. It owns and operates over 179,000 circuit kilometers of transmission lines and 280 substations across the country. Besides transmission, it manages national grid operations and load dispatch. It also monetizes its fiber optic network by leasing bandwidth to telecom players. Newer growth areas include smart meters and grid infra projects. Most of its projects are regulated, giving it steady and predictable returns. Backed by a 1.47 trillion rupees order book and visibility of another 500 billion rupees in bidding, Power Grid is well placed to benefit from the government's 9.2 trillion rupees transmission capex plan through 2032. In the past, dividends have been steady between the range of 12 to 15 rupees annually. For FY25, 7.75 rupees has been declared so far. However, looking ahead, capex is rising sharply from 230 billion rupees in FY25 to a guided 350 billion rupees in FY27. Projects like Khavda-Nagpur and Pangle HVDC lines and smart meter rollouts in Gujarat are key execution drivers. The company is also tapping green loans, international partnerships, and bulk equipment buys to stay ahead of timelines. The management has indicated that dividends may moderate as capex ramps up, but emphasized that they will remain healthy, striking a balance between growth and shareholder returns. Between FY20 and FY24, Power Grid posted a 5.5% revenue CAGR and 9.1% profit CAGR. ROE and ROCE averaged 19.3% and 12.3% respectively. In a world hooked on momentum, dividends offer something radically simple, that is cash in hand. Not a projection, not a story, just actual money returned to the shareholder, no questions asked. Dividends don't promise fireworks, they don't chase headlines, but they do one thing remarkably well: reward patience. Over time, these steady payouts can add up to serious compounding, especially when markets stall, valuations stretch, or volatility becomes the norm. But a word of caution: not all high-yield stocks are safe, and not all safe stocks will keep paying. A juicy dividend today can be a trap tomorrow if it's built on shaky grounds. That's it for today. Don't forget to like this video and share it with your friends and family and make them as smart as you are. This is Zil from Equitymaster. Thanks for tuning in.